What is going on, everybody? Welcome to this video. In today's video we are going to be talking about pattern trading and how to avoid it. So basically a pattern trade is something we want to avoid because it's not high probability setups, and yeah, let's just get straight into it. So first of all, I'm gonna show you a couple examples of pattern trading and how it can look, and we'll study it on the chart afterwards. So this is my number one example. This mechanically looks like a decent setup right here. We swept buy side liquidity, tapped into a higher time frame for value gap, and got this nice inversion right here. And some people would probably take this and put the stops like right here, target the next major sell side liquidity or something. But why is this a pattern trade and why should you avoid it? I can tell you that this setup right here will fail like 80-90% of the time. Well, the main reason is because we left equal highs up here, as you can see. Ding ding right here. And equal highs, as we know it, is very powerful. Like it's like a magnet for the price action. So in a case like this, where we left equal highs, we can either wait for them to get reswept and then get a nice inversions as well, or we could use them as a target. Let's say we drop down, we sweep these lows right here, and we get a nice inversion like right here. We could target them instead. It really depends on your bias, your drawn liquidity, and a lot of other things. So avoid this setup. Anyways, my number two example is this right here. This is for the continuation model. Let's say we swap some major sell side down here. We are delivering from a 4-hour fair value gap or some shit like that, 50-minute fair value gap, and we are clearly displacing higher right here. And in this case right here, we tap a 5-minute fair value gap, bang, and we get a nice inversion right here. And this would be our continuation model to proceed up. Now, why is this a bad setup right here, and why will it fail 90% of the time? Well, because in this case we also have a unmitigated 5-minute gap down here. So you need to be aware. This is like, I mean, it's the exact same as equal lows. They are like a magnet to the market. It's a very dangerous place. Sometimes pattern trades work, sometimes they don't. But in a case like this, you should wait for this last percent fair value gap to be tapped and then find your entry within this area right here. And bang. Alright, that was number two. Let's check out number three. So mechanically, again, let's say your bias, your drawn liquidity aligns, we sweep some buy side liquidity with delivering from a higher time frame fair value gap, but it takes extremely long to inverse this fair value gap we have down here. Now what happens when it takes so long? We are generating all of this low resistance liquidity right here, which is very dangerous on our side. What do we wait for then? We wait for a remanipulation of these highs right here, and then wait for our entry. Bang. In most of these cases, these plays will fail, and you can go study them on the charts. I'll find some examples right now as we speak, and yeah, let me just show you some examples. Alright, so for instance, if we see something like this, so we want to maybe target all this low resistance liquidity right here, and we are very bearish, let's say we are, and we have an SMT with ES with this high right here, and we are delivering from this 15-minute gap as well as a 1-hour gap. So we want to be looking for sells, and let's see if we get a good sell. Yeah, let's say this one right here. See, we get the inversion right here. Put our stops like right here or something, and target some of this low resistance liquidity right here. Whoops, we end up getting stopped out. Now why is this and how could you avoid it? Well, if you open your eyes a little bit, what happened here? We created these equal highs right here. And remember I told you that the market likes equal highs so much that it wants to stop you out before getting a win. Bang, we get stopped out. It did take the equal highs. And now we proceed to deliver to our target. So in this case right here, what could you could have waited. You could have been patient, and you could have taken something like this right here instead and target the low resistance liquidity, and then it would have played in your favor. So yeah, look for equal highs and equal lows every single day coming into the market. Let's find an example of the continuation setup failing. So let's say in this case we are looking to shorting a continuation model right here, and we see a 5-minute gap open up. We take the 5-minute gap right here. Now let's say we are going on to the lower time frame, and we see our inversion right here. Very small inversion, but it's whatever, it's just an example. And you take this, bang, you get tagged in right here. Target some of this down here, and you got stopped out. Brutally stopped out, actually, in this case. So let's see what went wrong. Let's go to the higher time frame. Oh, what is this? We have a 5-minute fair value gap up here as well. How about a 50? Oh, we also have a 15-minute gap up here as well. Now I won't be looking to just shorting this 5-minute fair value gap. I want to retrace up into these fair value gaps and then get my continuation model. So let's see what happens. Bang, you got stopped out here. And let's see if we find a valid entry. Yeah, we got this 2-minute entry right here then. And bang. Stop taking the first 5-minute continuation model you see and start looking at the 5 and 15-minute time frame to see if we have any unmitigated gap in our continuation model, or else you'll get screwed, just like this dude got screwed right here. So let's find a chart example of the last one. So last but not least, let's look at this example right here. We swept out all this low resistance liquidity right here, and I want to be shorting, and I see this nice gap right here that we could use to short. Ugh. Took so long to inverse it. Took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 minutes to get a close on this short right here. And you would have taken your short here. Notice how you left all this low resistance liquidity right here, and you still took this short and got brutally stopped out. And then it proceeds to deliver. Listen, you could have taken an entry like over here or something like that. We got this. It's a very small inversion, but it's whatever, it's for the example. You could have taken this trade after seeing this low resistance liquidity get taken, or something like that. This is how to avoid getting stop rated. Yeah, that'll be it for me in today's video. I hope you liked it. If you did, make sure to leave a like, maybe subscribe or some shit like that. Thank you for watching.